The silver market was euphoric. Prices were exploding, headlines were screaming shortages, social media was flooded with talk of a historic breakout, and traders across the globe were convinced that silver was finally about to repeat its legendary bull runs of the past. Then, quietly, almost invisibly, one man positioned himself on the opposite side of the trade. While the crowd was celebrating silver's surge, a Chinese billionaire trader was preparing for its collapse. His name is Bian Ximing. Most people outside professional commodities circles had never heard of him. He doesn't give interviews, he doesn't attend flashy conferences, he doesn't post trade alerts or chase fame. Yet behind the scenes, Bian had already pulled off one of the most profitable trades in modern commodities history, making nearly $3 billion by betting on gold when most of the world was still skeptical. Now, with silver racing higher at breakneck speed, he made a move that stunned seasoned traders. He went all in against silver, not a small hedge, not a cautious position. One of the largest short bets ever seen on the Shanghai Futures Exchange. And when silver suddenly collapsed, that bet exploded into a paper gain approaching $300 million in just days. According to Bloomberg, which analyzed Shanghai Futures Exchange data and spoke with people familiar with the trades, Bian Ximing has built the exchange's largest net short position in silver, a position equivalent to roughly 450 tons of the metal, or around 30,000 futures contracts. The information was reported by Bloomberg News, citing exchange data and sources who requested anonymity because the details are not public. To understand why this trade matters, and why it has shaken confidence in the silver rally, you have to understand who Bian Ximing is, how he made his fortune, and why his view of silver is radically different from the crowd's. Bian is a Chinese futures trader who rose to prominence by doing something that most professionals failed to do consistently, staying aggressively bullish on gold long before it became fashionable. Beginning in early 2022, while many analysts were still debating whether inflation was transitory and whether interest rates would crush precious metals, Bian was building massive long positions in gold futures on the Shanghai Futures Exchange. As central banks began buying gold at record levels, geopolitical risks intensified, and faith in fiat currencies weakened, gold surged. Bian rode that rally with conviction. Bloomberg estimates that his bullish gold bets generated nearly $3 billion in profit over roughly 3 years. That track record alone demands attention. But what makes Bian even more unusual is his temperament. In a market dominated by loud personalities and public bravado, he operates in near silence. Bloomberg reports that he avoids the limelight and spends much of his time in Gibraltar. In China's futures markets, however, he is known as a larger-than-life figure, not because of media appearances, but because of the sheer scale and consistency of his trades. He is also known for his investment philosophy, fragments of which have circulated online and earned him a loyal following among Chinese traders. The philosophy is simple, but ruthless. Ignore narratives, respect positioning, and never confuse speculation with fundamentals. That philosophy is what led him to silver. Silver, unlike gold, lives a double life. It is both a precious metal and an industrial commodity. For years, silver has lagged gold, frustrating investors who believed it was undervalued. Then, suddenly, silver prices exploded. The rally was fast, emotional, and heavily leveraged. In Shanghai, silver surged to an all-time high. Speculators piled in. Momentum traders chased the breakout. Social media was flooded with claims that silver shortages were imminent and that prices could double or triple. But Bian saw something else. According to Bloomberg's analysis, Bian began ramping up silver short positions in the final week of January, just as enthusiasm was peaking. He executed these trades through Shanghai Futures Co., a Chinese brokerage. While the Shanghai Futures Exchange does not disclose the identities of individual investors behind brokerage accounts, people familiar with the matter told Bloomberg that Bian's own trades, along with products he directly manages for a small number of clients, make up the majority of Shanghai's precious metals positions. On January 28th, exchange data showed Shanghai's silver short position surged to about 18,000 lots. 2 days later, on January 30th, that position grew to roughly 28,000 lots, exactly when silver prices in Shanghai hit an all-time high. This was not coincidence. This was a deliberate attempt to call the top. At first, the trade was painful. Silver remained volatile. Prices surged higher even after Beyond increased his shorts. Bloomberg reports that he was forced to liquidate some positions at a loss as the market moved against him. For most traders, this would have been the moment to retreat, to cut exposure, to admit defeat. Beyond did the opposite. Instead of abandoning the trade, he adjusted it. He spread his exposure across longer-dated contracts, reducing the risk of short-term squeezes while maintaining his core bearish thesis. He held the position through sharp upward swings, absorbing volatility that would have destroyed less disciplined traders. Then, the market turned. In a matter of days, silver prices collapsed. According to Bloomberg, silver tumbled more than 16%, an extraordinary move for a metal that had been trading with extreme bullish sentiment just weeks earlier. That collapse transformed Beyond's short into a massive winner. Bloomberg estimates that the drop generated a paper gain of around 2 billion yuan, roughly $288 million on his current position alone. Including earlier losses from attempts to time the top, Beyond is still on track for a net profit of approximately 1 billion yuan, based on prices at the end of Tuesday trading, referenced in Bloomberg's report. Silver continued sliding in Thursday trade, which likely increased those gains further. This wasn't luck, it was structure. To understand why Beyond was willing to take such risk, you have to look at how he views silver relative to gold. Gold is a monetary metal. Its demand is driven by central banks, long-term wealth preservation, and macroeconomic uncertainty. Even when speculative flows enter gold, they tend to rest on a deep base of sovereign and institutional demand. Silver is different. While silver is often marketed as poor man's gold, its price behavior tells a different story. Industrial demand plays a major role. Solar panels, electronics, and manufacturing cycles influence silver far more than they influence gold. When speculative flows dominate silver, the market becomes fragile. Bloomberg notes that many market watchers have begun rethinking their unified approach to precious metals. While gold continues to be viewed as a hedge against interest rate shifts, central bank buying, and geopolitical risk, silver's rally is increasingly seen as speculative, driven by positioning rather than fundamentals. This distinction is critical. Beyond understood that silver's surge was not being driven by a sudden collapse in mine supply or an explosion in industrial consumption. It was driven by leveraged enthusiasm, and leveraged enthusiasm unwinds violently. This wasn't Beyond's first time trading silver. In fact, he had already made a fortune on the metal before turning bearish. According to Bloomberg's calculations based on exchange data, Beyond built a long position in silver from August of the previous year that generated more than 1.3 billion yuan in profit. He rode the upside, then he stepped aside. By November, he began shifting his stance. He made tentative attempts to call the top, sometimes getting stopped out as prices continued to climb. But rather than abandoning the market entirely, he studied the flows, the positioning, and the psychology. When silver finally reached an all-time high in late January, Beyond acted with conviction. This is what separates elite traders from everyone else. They are not married to direction. They are married to timing, structure, and probability. Beyond's trade also highlights a deeper issue in global markets, the danger of narrative-driven investing. Silver's rally was supported by compelling stories, but stories alone do not support price indefinitely. When positioning becomes one-sided, even good stories collapse under their own weight. Bloomberg's reporting makes clear that Beyond's position was enormous relative to the market. A short equivalent to 450 tons of silver is not a casual bet. It is a statement. It also carries extreme risk. If silver had continued higher, losses could have reached catastrophic levels. Short positions have theoretically unlimited risk. Beyond knew this. He accepted it. And he structured the trade to survive volatility long enough for the thesis to play out. That is not gambling. That is professional speculation at the highest level. Beyond and Shanghai Futures did not respond to Bloomberg's requests for comment. That silence fits his profile. He does not explain trades, he lets results speak. Bloomberg also notes that its profit estimates are based on reconstructed changes in Shanghai's positions using daily Shanghai Futures Exchange data. Because the exchange does not disclose position costs or exact entry prices, there may be small discrepancies in the calculations. Even so, the scale of the trade and its impact are undeniable. The implications go far beyond one trader's profit. Silver bulls must now confront an uncomfortable reality. One of the most successful precious metals traders of the past decade believes silver's surge was unsustainable. Not because he dislikes silver, but because he understands how markets behave when speculation outruns fundamentals. This does not mean silver is finished forever. It means that violent corrections are a feature, not a bug, of speculative markets. Bian's trade is a reminder that markets do not reward belief. They reward discipline. It also exposes a stark contrast between gold and silver. Gold's rally has been slow, methodical, and supported by structural demand. Silver's rally was fast, emotional, and leveraged. Those differences matter. For retail traders and investors watching from the sidelines, Bian Ximing's story carries an uncomfortable lesson. The biggest money is not made by chasing headlines. It is made by stepping back, studying positioning, and being willing to stand alone when everyone else is convinced. When silver was being celebrated as the next unstoppable trade, Bian was quietly preparing for its collapse. And when the collapse came, it came fast. According to Bloomberg, weeks of dramatic price swings are now forcing investors to reconsider whether gold and silver should even be treated as the same asset class. The divergence between monetary demand and speculative excess has never been clearer. Bian Ximing didn't just bet against silver, he bet against the crowd. And once again, the crowd paid the price. This is not the story of a lucky trader. It is the story of a man who understands that markets move not on hope, but on imbalance. When imbalance becomes extreme, reversal becomes inevitable. Silver's collapse may not be over, or it may stabilize and rebuild. But one thing is certain, the idea that silver can only go up has been shattered. And somewhere far from the spotlight, a Chinese trader who already conquered gold is counting another massive win. All reported figures, positions, and profit estimates in this analysis are based on Bloomberg News reporting and Bloomberg's analysis of Shanghai Futures Exchange data, as cited in Bloomberg's international coverage of Bian Ximing and Shanghai Futures Co. If markets are a battlefield, this was a perfectly timed ambush, and silver never saw it coming. If you found this video valuable, don't forget to subscribe, like the video, and share your thoughts in the comments below.